So, have you ever actually wondered how major businesses can sell huge amounts of goods on credit, giving their buyers months to pay without totally destroying their own immediate cash flow? Think about it. Imagine a furniture manufacturer. They need raw lumber today, but they honestly can't pay the supplier for, say, 90 days. It's a massive challenge for the supplier who needs to get paid, right? Well, the financial world has a pretty brilliant solution for this. Welcome to This Explainer. Today, we're diving into the fascinating journey of commercial promises, specifically looking at exactly how bills of exchange and promissory notes work. Now, how do businesses actually solve this core problem in commercial transactions? Because buyers almost always need materials or goods right now, but they often lack the immediate cash. And on the flip side, sellers absolutely need to make the sale, but they also need guaranteed funds to keep their own lights on and pay their workers. The real trick here is finding a legally binding way to turn a buyer's promise to pay later into a valuable instrument that a seller can use to generate cash today.
So here is how we're going to break this all down today. First, we'll cover the basics of credit instruments. Then we'll compare bills versus promissory notes. After that, we'll get into the math of calculating the maturity date, explore the 4 possible fates of a bill, and look at what happens with renewal and early retirement. Finally, we'll wrap up with a quick recap and some absolutely essential exam tips.
Okay, let's jump right into part 1, the basics of credit instruments.
When we talk about a bill of exchange, you really need to pay attention to the precise wording of the definition. A bill of exchange is an instrument in writing, sure, but notice the key phrase here. It is an unconditional order. It is definitely not a polite request. It's a strict directive, signed by the maker, legally instructing a specific person to pay a certain sum of money to a definite person or to whoever's holding the paper.
Building on that, for a bill of exchange to actually be valid, it has to hit a few non-negotiable criteria. Obviously, it must be in writing, it has to be dated, and the payment must be in legal currency. But here is the major trap where students constantly lose points on exams. To prevent me from just writing a note saying you owe me $1 million, this order only becomes a valid legally binding bill once it is accepted in writing by the person who is supposed to pay. Until they literally sign their name on it to accept the terms, it's just a worthless piece of paper.
To confidently nail down the 3 parties involved in a bill of exchange, which you will absolutely be tested on, just remember the DDP memory trick. The drawer is the one making the order. Think of them as the dictator dictating the terms. The drawee is the person who accepts the order. They are the debtor who actually owes the money. And finally, the payee is the person who pockets the cash at the end. And just as a quick side note, the drawer and the payee can actually be the exact same person. If I write a bill ordering you to pay me, I am both dictating the terms and pocketing the cash.
Let's shift gears now to the other main instrument, the promissory note. Do you see the fundamental shift in the definition here? We've moved away from an unconditional order, and instead, we're dealing with an unconditional undertaking, or simply, a promise to pay. It's a direct, self-initiated pledge coming straight from the debtor themselves. Because a promissory note is a direct promise, it fundamentally changes our party structure. For this one, just remember the MP mnemonic. We only have 2 parties here. The maker, who makes the promise and signs the note, and the payee, who pockets the cash. Unlike a bill of exchange, this instrument does not require any sort of external acceptance. Why? Because the person writing it is already the one explicitly promising to pay. There's no one else who needs to agree to it.
Moving on to part 2, let's do a direct showdown. Bills versus promissory notes.
This is highly tested, so pay close attention. A bill is an order with 3 parties. A note is a promise with 2 parties. But the biggest difference is the liability. In a bill of exchange, the drawer's liability is secondary and conditional. That's because the drawee, the person who accepted it, is the primary debtor. They are supposed to pay first. The drawer is only on the hook if the acceptor fails to pay and a formal notice of dishonor has to be given. But with a promissory note, the maker's liability is primary and absolute. They made the promise, they must pay, and absolutely no notice of dishonor is needed if they fail.
All right, part 3, calculating the maturity date. This is where the math comes in. I want you to burn the number 3 into your memory. The number 3 is your absolute best friend when calculating maturity dates. By law, every single instrument that is payable otherwise than on demand, meaning it has a set future time frame, is entitled to 3 days of grace. It's a little breathing room for the debtor. You must always add these 3 magical days to the expiry date to find out when the bill is legally due. If you forget to add 3 days on your exam, your calculations will be wrong every single time. So when you map this out on a timeline, the clock starts ticking.
but you really have to watch out for a massive exam trap right here. If a bill says it's drawn after date, the clock starts running from the exact date the bill was physically written. But if a bill is drawn after sight, the term only begins from the date of acceptance, when the drawee actually saw and signed it. Once you figure out the expiry date based on those specific rules, you add your 3 days of grace, and boom, you've landed on the final legally binding maturity date.
But wait, what if that maturity date happens to fall on a holiday? For this, you just need the PEN mnemonic. PEN. If the maturity date is a known public holiday, the due date shifts to the preceding business day, so the day before. But if it's an emergency or totally unforeseen holiday, like a sudden national mourning day, the due date shifts to the next following business day. Public equals preceding, emergency equals next. Keep that straight and you'll be golden.
Let's look at Part 4, the 4 fates of a bill.
So, you are the seller, and you now hold this legally accepted piece of paper. What do you actually do with it? Well, you have 4 options. First, you can simply hold on to it until maturity, present it, and collect your cash. Second, you can endorse it. This means passing it on to pay off someone you owe money to, very much like endorsing a check over to a supplier. Third, you can discount it with a bank. This is huge. If you need cash right now to make payroll, you give the bill to your bank. They give you the cash immediately, minus a small early access fee called a discount. Or fourth, you can just send it to your bank a few days before it's due and let them handle the collection safely. Now, what happens if the maturity date arrives and the debtor just flat out refuses to pay? This is called dishonor. To prevent the debtor from lying later and claiming, hey, nobody ever presented that bill to me, the holder has to use an official called a notary public. Noting charges are the exact fees paid to this official to legally document the facts and causes of the dishonor. Accounting-wise, and this is a big exam point, these charges are initially paid out of pocket by whoever is holding the bill at that moment, but the cost is ultimately recoverable from the drawee because it's their fault the mess happened in the first place. Which brings us to Part 5, renewal and early retirement. Sometimes things don't go according to the original plan. If a debtor knows in advance they aren't going to be able to pay on time, they might come to you and ask for an extension or a renewal. To properly account for this in your journal entries, you have to follow 3 exact steps. Step 1, you must legally cancel the old original bill. Step 2, you calculate and charge interest for the extended time period. After all, time is money, and you're waiting longer for your cash. Step 3, you draw up a brand new bill that includes the original principal amount plus that newly calculated interest. Cancel, interest, new. On the flip side, what if the debtor suddenly has extra cash on hand and wants to pay you early? This is called retiring a bill under rebate. Because they are paying ahead of schedule, the seller grants a discount, which is known as a rebate. To calculate this, you take the total bill amount, multiply it by the agreed rebate percentage rate, and then multiply that by the unexpired time over 12 months. We use 12 months because these rates are usually quoted per annum, so you have to prorate it for the exact months remaining. Okay, Part 6, the final recap and exam tips to lock this all in. Let's do a rapid-fire run-through of your ultimate cheat sheet. Remember your parties. DDP for the 3 parties of a bill of exchange, drawer, drawee, payee, and MP for the 2 parties of a promissory note, maker, payee. Absolutely never forget to add your 3 days of grace to non-demand instruments. When holidays strike, use the PEN rule. Public means preceding day, emergency means next day. And if a bill needs renewing, just follow the 3 steps. Cancel the old, calculate the interest, draw the new. We've just seen how a simple promise to pay, when put into writing and bound by these specific rules, turns into a powerful financial tool that literally keeps the global economy moving. By understanding the parties involved, the strict timeline rules, and the exact accounting treatments for every possible fate of a bill, you've just unlocked a major pillar of commercial accounting. So the only question left is, are you ready to track the journey of every promise and completely master your accounting exams? I certainly think you are. Keep reviewing these core concepts, practice those journal entries, and happy learning.
Welcome, everyone. Today, we're diving into the ultimate exam masterclass on mastering accounting for bills of exchange. Now, I know this topic can feel kind of overwhelming at first glance, but I promise you, by the end of this explainer, you're going to walk into that exam room with total confidence. We're going to break down the mechanics, the journal entries, and the actual logic behind it all, so you aren't just blindly memorizing things, but you actually understand the core concepts.
Okay, here's our game plan for today. We're going to start with the basics of bills, then face the reality of insolvency, After that, we'll unlock the magic of accommodation bills, breeze right through bills sent for collection, take a quick look at daybooks and records, and finally, bring it all home with a final exam recap.
All right, let's jump right into Section 1, the basics of bills, understanding the core.
So picture this. You've got a customer who owes you a good chunk of money for some goods you just sold them. A verbal promise? Sure, that's nice, but you need legal certainty. Or maybe you need immediate cash, like right now, to pay your own suppliers. Well, that is exactly where bills come into play. Let's look at the definitions here, because getting this conceptual clarity right from the start is going to be your best friend. A bill of exchange is an unconditional order in writing directing a certain person to pay a specific sum of money. You are literally ordering someone to pay. On the flip side, a promissory note is an unconditional undertaking to pay a sum, meaning you are promising to pay it yourself. Ordering versus promising, that's the core difference right there. And that fundamental difference changes who's actually involved. A bill of exchange has three parties. You've got the drawer who makes it, the drawee who accepts and pays it, and the payee who actually receives the money. Honestly, a lot of the time, the drawer and the payee are the exact same person. But a promissory note, that only has two parties, the maker who promises to pay and the payee who gets the funds. Okay, listen up, because here is a major exam red flag. Under Section 31(2) of the Reserve Bank of India Act, a promissory note can never legally be made payable to the bearer. No exceptions. It has to be payable to a specific person. Make sure you don't miss that one on test day.
Now, when we actually get into the accounting, like looking at journal entries for discharging and renewing bills, the absolute secret to mastering this is the follow the asset or liability rule. Whenever you feel stuck, just take a breath and ask yourself what's coming in and what's going out. When you discharge an acceptance by handing over cash in a new bill, bills payable gets debited. Why? Because that old liability is going out. It's canceled. Cash gets credited because it's leaving your hands, and a new bills payable is credited because, well, a brand new liability is born. And hey, even if interest gets tacked on, don't panic. It's just an added expense sitting right there on the debit side.
All right, so we know exactly how to record things when they go right, or even when a bill just needs to be renewed. But what happens if the acceptor goes completely bankrupt before the due date? Like, what if the money literally just isn't there?
Well, that brings us to Section 2, the reality of insolvency, the worst-case scenario.
So, insolvency basically means a person or a business just cannot pay their debts anymore, which means any bills they've accepted are definitely going to be dishonored. To handle this in an exam without losing your mind, you just need to break it down into 3 super logical steps. Step 1, always cancel the original bill. It's dishonored, right? So reverse the entry. Step 2, record whatever partial cash you actually managed to squeeze out of the insolvent person's estate. And Step 3, write off the remaining amount, the stuff you're never getting back as a bad debt in the drawer's books. 1, 2, 3. Stick to that sequence and you'll nail every single insolvency question they throw at you.
Let's actually apply this logic. Imagine a drawee becomes insolvent and his estate can only pay 50 paise in a rupee, so exactly 50%. When you look at the books of the person receiving the cash, they get half the money, so they debit bank and they debit bad debts for the half they lost. Simple enough. But from the drawee's perspective, there is a brilliant little memory trick you can use. I call it the bank deficiency split. Whatever he can pay goes to the bank account, and whatever he cannot pay goes straight into a special account called the deficiency account. Keep that locked in your mind. Bad debts for the person receiving, deficiency for the insolvent payer.
Now, here's a kind of fascinating question for you. Can you use a bill of exchange to drum up emergency cash, even if no goods were ever actually sold or traded?
Let's find out in Section 3, Accommodation Bills, Raising Finance. So the answer to that question, absolutely yes. Now, I know this is notoriously one of the trickiest topics on the exam, but honestly, it's a very relatable real-world scenario. Normally, bills are there to facilitate actual trade, right? Goods for money. But this whole mechanism can also be used simply to raise finance. We call this an accommodation bill. Think of it like 2 friends co-signing a bank loan just to help each other out. Let's say a business owner desperately needs some cash, so he draws a bill on a trusted associate who accepts it. The owner then marches that bill straight to his bank, gets it discounted for cash, and uses those funds to solve his problem. Later, on the due date, he sends the cash over to his associate, who then pays the bank. No goods ever changed hands. They just used a legal piece of paper to unlock some temporary bank financing. Pretty clever, right?
But what happens if both parties need money? Well, they just split the cash from the bank. And this brings us to the absolute golden rule of accommodation bills. If you split the cash, you must split the cost. It's that simple. If you look at how the proceeds are divided between the parties, the math always lines up. Whoever takes a slice of that cash has to swallow that exact same percentage of the discounting charges. So if you take 50% of the bank loan, you have to debit your discount account for 50% of the bank's fee. It's just basic fairness, and it's exactly how you need to calculate those journal entries when sharing proceeds.
All right, let's take a quick mental breather and move to Section 4, Bills for Collection, Safe Retention.
We're shifting gears to a much simpler administrative procedure now. It's straightforward for sure, but it is still essential territory for your exam. Sometimes when a person receives a bill, they might just hand it over to their bank purely for safe retention until maturity. The bank just holds onto it and collects the money when the due date rolls around. But listen, I need to make this abundantly clear. This is not discounting. The bank is not giving you an advance cash loan here. They will not credit your account until the money actually clears on the due date. It is literally just a safety mechanism so you don't lose the paper.
And because it's just a safety mechanism, the journal entry logic is super clean. When you send it to the bank, you debit a specific account called Bills for Collection, and you credit bills receivable. Think of this Bills for Collection account as a temporary parking spot for your asset. That's all it is. If the money is realized, you debit bank and credit the parking spot. If it's dishonored, you debit the original drawee and again, credit the parking spot. See? It's just holding the asset's place. Super easy.
Moving right along, Section 5, Daybooks and Records, High Volume Tracking.
Now, in a big corporation, you aren't just sitting there passing isolated journal entries for every single bill that crosses your desk. When you're dealing with high volumes, you record them chronologically in special journals before they ever hit the ledgers. These are your bills receivable and bills payable books. They track the whole shebang chronologically, with columns for the date, the party, the due date, the amount, and the mode of disposal. Like, did you discount it, endorse it, just hold it? But here's your biggest takeaway for the exam. Individual transactions get posted to the specific debtor or creditor's personal accounts, but the grand totals from these daybooks are periodically posted directly into the main bills receivable and bills payable ledger accounts.
And finally, we have arrived at Section 6, Final Exam Recap, Non-Negotiable Rules.
All right, team. We have covered the entire life cycle of these bills. Consider this your final locker room speech before the big test. You've got the knowledge, now let's just sharpen it up. Let's rapid fire through these critical exam red flags. Number 1. When a bill is retired early, remember that the discount is a gain for the drawee who pays early and an expense for the drawer. Number 2. Noting charges. These are fees paid directly to a notary public to legally certify a dishonor. The bank might front the money, but the ultimate expense always falls on the drawee who failed to pay. Number 3. A foreign bill is simply one drawn in one country but payable outside of it. And finally, number 4. Whenever you're dealing with renewals, always calculate interest for the exact number of months agreed upon. Don't estimate it. Calculate the exact time frame.
Which brings me to one final question for you. If you truly master the simple logic of what comes in and what goes out, will you ever actually need to blindly memorize a journal entry again? Honestly, no. Whether you're looking at a basic collection, a complicated accommodation split, or a messy insolvency deficiency, logic always wins over rote memorization. Trust the rules we laid out today, always follow the asset, and you are absolutely going to crush this exam. Thanks so much for hanging out with me for this explainer, and happy studying.